out of them, right? You can get them to give a little bit more. So again, we do this with all of our clients. All advisors do this. You can do it online, however you decide to do it, but by running it's called a Monte Carlo analysis. But you want to be able to run a projection of what your future cash flow is going to look like so that you can really understand what to give. So then once you actually understand how much flexibility you have, right, then you get to the decision of, well, what should I give? Most people give cash because it's what they know. It's what's easy. They get the annual fund letter in the mail and they check off a box and they send in a check. Most of the time, cash is the worst gift you can make from an efficiency standpoint. At the museum, it doesn't matter to us whether you give cash or appreciated stock or whatever. But for you as a family, there's a lot of decisions that you can make here, right? You can give cash, number one and most popular. The next most popular is appreciated securities. So if you have stock investments, right, you can give stock, you can give real estate, you can give property, any of these things you can donate, and the charitable organization will usually sell it and take it as cash. If you have IRAs or tax deferred accounts, you can give money out of those accounts. That ends up ultimately being a cash gift, but it's just treated differently tax-wise. And I'll show you how in the next slide. So this example is comparing those three types of gifts, right? We have the cash gift column here. We have a stock gift column here, and an IRA or 401k gift column here, and that's called a qualified charitable contribution. For this example, this is a family who itemizes their deductions. For round number purposes, they have an adjusted gross income of $150,000, and they're making total gifts for the year of $10,000. That puts them in the 24% federal tax bracket, the 7% state tax bracket, and a 15% capital gains tax bracket. If you change the year, how much income you have for the year, that obviously impacts these tax brackets and ultimately what you save in terms of a tax deduction. I made the distinction up here that the family itemizes their deductions because that's a very important piece of this entire analysis. In 2018, the most comprehensive tax law changes in probably ever were passed and put into law. Most people recognize that and know of that as one of the biggest tax cuts we've had in history. Part of that large tax cut was an increasing of the standard deduction. What that means is that a majority of folks, now 90% of families, actually don't itemize. That's important because when people make charitable gifts, they assume that it's a tax write-off, that you can deduct it against your income. In actuality, you can only deduct a charitable gift from your income if you itemize your deduction. So 90% of families in this country do not itemize their deduction and thus do not get a tax write-off for making their deduction, which is why I say in the beginning that cash is one of the worst things you can give from an efficiency standpoint, because if you don't get the write-off, you don't get any additional tax benefit. So here, in this family who itemizes deductions, if you gave a cash gift, you would save $3,100 for taxes. If you were to make a gift of stock that had a low cost basis, you would actually save $5,300. So that's the deduction on the tax side, and then the not having to pay capital gains in the long run. So you kind of get the double dip on the tax savings. And then this third basic strategy, the IRA gift, you save $3,100 as well. So again, of the three, cash is tied for the worst, right? The best you could do is actually make a stock gift. So again, this is only 10% of families in this country who would fall under this scenario. The rest of us who do not itemize our deductions are in a much different situation. So again, if this family who does not itemize deductions makes a cash gift, there's actually no tax benefit. You're just giving the money out of the kindness of your heart, which is fantastic. We appreciate that and we love it, and good for you. But if you could give low basis stock, save an extra $2,200, then you can either give more to the museum, right? Or you have an extra $2,200 in your budget. In this example, where a family doesn't itemize their deductions, actually taking it out of the IRA or the 401k and making that qualified charitable contribution is the most tax efficient. So in this example, they saved the $3,100. The larger point here is that there's a lot more that goes into your charitable giving than just determining how much you want to write the check for. Right? If you want to be maximizing your efficiency of your dollars, you need to understand, do you itemize or do you not? And that's an easy question that many of us know, and if not, you can just consult with your tax advisor. And then you need to understand, what do you have available to you, right? We all have cash. Many of us have a stock portfolio, and a lot of us have an old 401k or an IRA that we've saved over the years as well. It's not difficult to do these calculations, right? You can do them yourself online by looking up a few assumptions. Your tax advisor can certainly do it. Your financial advisor can certainly do it. And of course, we can do it, right? The larger point is you need to be thinking about this and having this conversation either with yourself or with someone or with a qualified professional, just to make sure you're not wasting dollars, essentially. Any questions on any of that so far? Excellent. So the next few slides, I'll just get into some of the more advanced strategies. And again, I don't want to get into any of the details just because we can get lost in the weeds very quickly, but these are more long-term legacy building strategies that in my experience working with clients for the last 15 years, folks aren't they're not as common, folks aren't as fluent with them. And when I bring them up with people, they're usually, especially people who are charitably inclined, are usually really excited to learn about. So donor advised funds and family foundations. This is a way to make a gift, get the immediate tax deduction, and then be able to spread the giving to the charities over a long period of time. So you usually hear about family foundations with the ultra wealthy folks, right? The Rockefeller Family Foundation, for example. They pump a whole bunch of money into it. It's this crazy huge organization that employs a bunch of people in their family, and they can get rather corrupt rather quick, actually. But the larger point is you put a bunch of money in it, you invest it, and then you make gifts over time. So you can build that legacy long-term, long into the future. For most people, it doesn't make sense to set up a family foundation. You have to have expensive legal fees. You have to have expensive administration fees. And the dollars just aren't high enough to make that worth it. For the rest of us, they have what are called donor advised funds that accomplish the same thing. And you can open these accounts with Schwab, with Fidelity, with any of these financial institutions. The benefit is you can make the tax contribution today, and then again, spread it out over the years. So if you just were to donate $10,000 to your own donor advised fund, you control it, you maintain the control, you choose the investments that you want to invest in, and then you can divvy out donations along the way for the rest of your life and the rest of the life of whoever you decide to succeed it. This is important because oftentimes, you'll remember I mentioned earlier that 90% of people don't itemize their deductions, so they don't get that big benefit from donating cash. If you were to if you earn a high income year, or you're to make a big donation in any given year, you can bump yourself into that itemized bracket, get the extra tax benefit, and then maintain control of those assets over the next however many years. So just for example, if you plan on giving $1,000 a year to whoever for the rest of your life, tax-wise, it might make sense for you to make a $10,000 gift today. But if you don't want to give that all to the charity today because you'd rather, for cash flow purposes, spread it out, you can give it all to the donor advised fund, get the immediate tax deduction for the $10,000 gift, and then give the museum or whatever charity you want the $1,000 a year over the next 10 years, plus any growth in the investment. These have become a lot more popular, again, with that tax law change because so few people get to itemize. So what many people are doing is they're bunching their donations in the way that I described so they could get that extra tax benefit and then still maintain control of their donations over the next handful of years. This is also a really good way to get multi-generations involved. So I have a few clients who have their donor advised funds. They put a bunch of money in it and they have their kids control it. So their kids are the ones that control the investments. They work with me and we do the meetings with them. The kids are the ones that control the donations to the distributions to charity over time. And it's a really good kind of education tool, a really good way to get the next generation involved in both charitable giving, but also getting them used to and exposed to money, getting them used to investing, getting them used to charitable donation. It's a really good way. So rather than all of a sudden the next generation inheriting a bunch of money at your death, you can kind of ease them into it and get them used to it, get them involved with your advisor, get them involved with your tax advisor, make those introductions. And it just makes for a much more seamless kind of transition into the next generation. Some of the more complicated strategies and something we saw recently at the museum are what are called charitable remainder trusts. These come into play a lot of times when you have families who have very low basis stock. So a lot of the times I'll see families get paralyzed with stock holdings because they bought just say, for example, Apple 20 years ago when it was barely worth anything. And now today it's one of the most rich companies in the world. Well, if they were to sell their Apple shares, they would have to pay a whole bunch of taxes. And none of us like taxes. So oftentimes they'll end up holding the shares forever until they die, at which point they get a step up in basis and don't have to pay the taxes. That's not the best long-term planning strategy because you're then at the beholden of Apple's share price, right? Apple's had a really good year this year. It's up 70%, but a couple of years ago, there was a point where it was down 40%. Why take that risk when you don't necessarily have to, especially if you're charitably inclined? So what you can do with a charitable trust is you can put shares of stock into the trust, avoid all of those taxes, and then over the rest of your life, the trust actually pays you back. So just to use round numbers, if you put $100,000 into a charitable trust, you can decide how much money you want to actually take out from that each year. And then whatever's left at the end of the day gets donated to the charity. You get a tax deduction today based on how much money you decide to take back. So if you were only to take 4% back from that trust each year, you get a pretty good tax write-off. If you want, you can take back 15% of the trust and get less of a tax write-off. That obviously has different implications, right? Because you leave less to the charity at the end of the day, but you get more back in your name. The benefit here is that you get that diversified, that concentrated stock into a diversified portfolio. So now you're not risking $100,000 that once was applied just to Apple. You can get it diversified. You have less portfolio risk. You get the immediate tax benefit. You get the long-term charitable impact. And you still have some cash flow coming back to you, so you're not getting rid of it completely. It's a more complicated strategy and one that works really well in certain situations, but certainly something that, again, you're going to want to talk to either your financial advisor or your estate planning attorney or your tax advisor to make sure it makes sense for you. It can be very powerful, though, in the right situation. And at the museum, we saw this year how powerful it can be for us when we received the benefit of one of these trusts at the death of one of our members. So lots of really good things can come from it. This next version of the trust is the same exact example, except instead of the payments during your life going to you and the balance at death going to the charity, the payments during life go to the charity and the balance at your death goes to your heirs, to your next of kin. So again, just the same strategy, same setup, just if you have different goals, different wants for ultimately your money, you can set it up this way so that the charity is getting the benefit for the rest of your life with those payments each year. And then your next generation, your heirs, still get the lump sum at the end of the day of whatever's left. So let's see, any pros and cons? No, went through all that. So again, income tax deduction is a big one, especially when you can bunch things and make big gifts at once. No capital gains tax is important. I didn't mention that those investments, maybe not so obviously, those grow tax-free. So if you put $100,000 or $10,000 or whatever into one of these trusts, all of the investment gain is tax-free. You never pay taxes on that. If you are someone who's subject to the federal estate tax, all of that growth is out of the estate tax. You get immediate diversification, so you're not concentrated in one position. There's creditor protection, so if you ever get in trouble with creditors, the money in these trusts is protected from that. And you can create income from non-income producing property. That's a really good point that I missed. It doesn't have to be stock, right? It can be real estate, right? A lot of folks, they have rental properties. When you have a rental property, you depreciate your expenses down, and ultimately at the end of the day, you have a zero cost basis for most of us. So if you wanted to sell that rental property, you would have to pay a lot of taxes on the gain. That would really significantly cut down into the proceeds of that asset. So again, a lot of folks, just like a stock, they'll have that rental property or that second property, and they'll just wait till they die, because when they die, they don't have to pay those taxes. But again, that puts you at immediate risk of market fluctuations, and it doesn't give you the best use of that asset perhaps at this point in your life. So if you gifted a piece of property into one of these trusts, the trust can then sell that property, pay no taxes, diversify that into a portfolio, and see stable growth and get the benefit of the payments over the course of your life. So it doesn't have to be stock. It can be hard property as well. So that's all I have. Again, it's a pretty quick rundown without getting into any of the nitty-gritty details. But just really easy, kind of simple things that we can all do, that we can all talk about within our networks, both to help the museum and the donors make the best decisions that they can, but also kind of help us attract more donors and attract more people to the museum, just by educating folks on some of these strategies. Any questions on any of that? I know I went through it a little quick. Usually this is when we crack open the beers and the lobster rolls, but.
I got a question. So when you donated from the IRA and you didn't, or you don't itemize and you donate from the IRA, you still get $3,100 tax. But how does that work? Is that a direct deduction on the?
Yeah, that's a good point. So what I failed to mention was that only plays out well for folks who are in the required minimum distribution phase.
Okay.
So right, if you have an IRA and you're above 72 now, the government forces you to take an amount out each year because they're sick of giving you a tax break. So if your minimum distribution from your IRA is $20,000, then you have to pay taxes on $20,000. But if you do what's called the qualified charitable distribution, you can give up to 100%. You can actually give more than your RMD. You can give up to $100,000, but you can give that RMD to a charity and pay no taxes. Right. So if you give 10,000 of that 20,000 away, then you're saving $3,100 in taxes.
But if I have an IRA or I have 401, whatever, say my stocks are performing well or paying dividends, and I've got $8,000 worth of dividends or cash just sitting in the account, and I use that to write a check, or basically, can I pay that directly to the Brickstore Museum and use that as a deduction on my taxes?
Yep.
So just have the administrator writing a check to me for a distribution. I just make a contribution directly, and so it doesn't come to income as me, but I still get to deduct the tax. Is that deduct the contribution?
Yeah, mechanically, it's more just on the tax return. I don't remember exactly how it works. If it shows the 20,000 of income and then a $10,000 deduction, or if just not showing that income gets you I think it's just the income shows up as not taxable.
Okay.
So you save it that way. So that's why you don't need to be itemizing the deductions in order to take advantage of it. Because if I'm
itemizing and I write a check from my IRA, so I don't actually take a distribution from my IRA, but I just say, okay, send $2,000 or $1,000 to the brick store. Can I believe I could deduct that on my taxes, itemize it as a contribution because I'm donating the money. I got to check it. You know what I'm saying? So I don't actually take.
You can't double dip if that's what you're thinking. So you can't get the benefit of the line item deduction and the not counting it as income.
Okay.
So if you're already itemizing, whether you write a check for $10,000 out of your bank account or if you were to do $10,000 out of the IRA, net you end up in the same place. Mathematically, at least.
Correct, but then I'm not actually taking it out of my cash per se. I'm taking it out of tax-free. You know what I'm saying? I have the tax-free growth there. So if I use that and get the deduction, to me it's a benefit because now I'm not using kind of current earnings. I'm using something that's not, that's growing tax-free. So I look at it as like, okay, that's money that I haven't paid tax on yet. I'm not. If you follow me, you know what I'm saying?
Yep, and you're getting to a really good point. Is that there's very few ways to get money out of an IRA without paying any tax.
Yep.
Giving it to charity is one of those ways.
Okay, and that's kind of what I was getting at.
Yeah, at some point you're going to get taxed on your IRA or your 401k. So by taking advantage of that, whether it's during your life or during the life of whoever inherits it.
Yeah.
But if you either give it to a charity while you're living, or and we didn't get into this, but you can have a charity be the beneficiary of an IRA, so that when you die, instead of it going to your kids, because you're giving them plenty of money in other places, you can have a charity be the beneficiary of an IRA, and then they receive that money tax-free. So a lot of times people will have charities in their wills. Maybe they want to make a gift of X number of dollars. It's oftentimes more beneficial if you have an IRA or another tax-deferred account to just have the charity be the beneficiary, because then it's money that goes to the charity, doesn't get taxed, and your kids or whoever your other heirs are will take the money that would have gone to the charity in the will. Because the kids would have to pay taxes on the IRA. They don't pay taxes on cash sitting in the bank that you give to them.
No, this was very, very helpful. Thank you for putting it together.
Absolutely.
Yes, this was great, Chris. Thank you.
Sure thing. Yeah, and if anyone has any questions or thinks of something, I mean, obviously more than happy to. This is what I love doing. So more than happy to talk about nerdy tax law and finance
I
strategy.
think the lobsters and beer are required to get people to attend as well.
Yeah.
It's not quite the same over Zoom, but we can certainly do it again. Maybe we need to come up with a snazzier title.
Just put my picture all over it, and people will definitely flock to it.
Well, thank you very much, Chris. I really appreciate it.
Yeah,
certainly.
Thanks, Chris.
Thank you.
All right, everyone, have a great evening.
You too.
You too.
You guys too.
Bye-bye.
Bye.
We'll talk to you.